Not a great market reaction to all of the news announced this morning. You've got that $4 billion loss in the quarter. That's about 7 times the size that analysts were expecting, plus a $3 billion restructuring cost and a dilutive capital raise, with the Saudi National Bank serving as an anchor investor for that. Now, in other words, this turnaround will not come cheaply for the firm, and investors are losing patience after years of turnover in the C-suite. A series of multi-billion-dollar mishaps, including Archegos and Greensill, and macro headwinds facing the financial services industry broadly. But backers of the plan say the restructuring will lead to a smaller and more focused firm. And as a result, this includes a retrenchment in investment banking, more focus on asset and wealth management, and ring-fencing non-core low-return assets. Credit Suisse also agreed to sell a majority stake in its securitized products group to Apollo and PIMCO. The firm said both layoffs and attrition will also result in about 9,000 fewer jobs in 3 years' time. Nearly a third of that headcount reduction, though, will take place during this quarter. It's also putting the firm's capital markets and investment banking business under the CS First Boston brand. That's a nod to the U.S. bank that Credit Suisse acquired decades ago. Executives said they already have $500 million commitment from a reputable third-party investor who is also hailing from the Middle East to invest in that business. Credit Suisse says the plan will lead to a return on tangible equity of about 6% for 2025, a figure KBW analysts described as, quote, relatively low. However, the bank says that it's expected to deliver sustainable and attractive returns from 2025 onward. Guys.
Yeah, Leslie, I referenced that 6% ROE in 2025 as well earlier. One of the people involved in restructuring said, well, first it's about surviving, then it will be about thriving. They lost a lot of deposits over the last month as well. You know, I'd been assured even a month ago that there really wasn't a need to raise capital. Things may have changed. Tell us a bit more about, you know, what did happen? Did they really lose a lot of deposits because people got concerned?
They did lose a lot of deposits. They saw a lot of outflows. People were concerned by all of the media attention, the credit default swap spreads. You recall we talked about that quite a bit ago. Yeah. Those have all come down quite significantly. But that fear that kind of perpetuated over the course of the last month did lead to significant outflows for the firm. And as a result, they did, in fact, engage in this capital raise and were able to get that anchor investor from the Saudis. Now, they went about, and then this was something that was discussed on the media call, is kind of the reputational risk of bringing in the Saudis to invest so significantly in the firm, just given all of the geopolitical risk therein. And then they have another potential investor in their CS First Boston spinoff that they're looking to do. And, you know, so the question kind of remains, why tap those sources of capital? Why tap them now? And I think that's also kind of creating more fear, especially since the market really digested this idea that they didn't need to go out and do a dilutive raise.
Leslie Picker, thank you. It's amazing. $4 stock now.
Yes. Shepard Smith here. Thanks for watching CNBC on YouTube.